There are too many misconceptions about life insurance that it's no surprise only a small segment of the Philippine population is protected with life insurance. So today, we'll learn more about life insurance and what it can do for you. I'm Edric Mendoza, and this is On the Money. Joining us in this episode is Mylene Lopa, Chief Marketing Officer at Sun Life Financial Philippines. Hi, Mylene.
Hi, Edric.
Welcome.
Thank you.
Let's talk about life insurance.
Sure.
So it's said that the Philippines has a fairly small size. What does that number look like at this point?
Oh, the penetration for insurance in the Philippines, meaning the number of people who have life insurance in the Philippines, is less than 2%.
Less than 2%
of the population.
Not even one out of, or
well,
one or two out
there are
of 10.
those who get insurance from the companies they work for. So excluding that, I mean, those who actually bought for themselves is less than 2% of our 90 million.
Okay.
People.
Do you have a figure of those who are effectively just covered? I mean, through companies, etc.
If you include that, probably about 14%, including that, but still
small.
very low,
That's
right?
still very small.
So a lot of people.
Wow. So yeah, let's talk about why do you think?
Well,
why is it so low in our
there are a lot
country?
of misconceptions about insurance. One common objection to it is that people don't think they need it. They think it's an unnecessary expense. The common objections that we face when we try to offer insurance is no need.
No need.
No money. No hurry.
Okay. No need, no money, no,
no
hurry.
No need, no money, no hurry. So these are the common excuses that we hear from people.
Whereas, what is the truth? I mean,
the truth is, when they say no need, they think they're healthy, they're earning, they can well provide for their families, so they don't need insurance. But the truth is, if you have dependents who are relying on your income and you never really know what will happen to you, there's always a need to protect your income because you don't know exactly what will happen to you or when something bad will happen. So the need is always there. So it's not true that there's no need for it.
Right. Because people will think it's only for when you're about to die.
That's true.
Things like that. Did you want to expound on that?
Yes.
Is that a misconception?
Traditionally, maybe insurance products were really meant for just that, to pay an amount of money to the dependents of a person who has passed away. But these days, there are many different types of insurance. So when they say no need because they think they're healthy, actually there are many different needs that an insurance product can address. Even retirement. Even education for the children, even an investment. There are already insurance products that come with investment plans. So they serve very different needs. They serve a lot of financial needs that we all are in need of in various stages of our lives.
So we talked about no need. Let's talk about no money and no hurry. Maybe no money first.
No money. Well, a lot of people also say when they're offered insurance, I don't have the money now, it's an unnecessary expense or it's expensive. But probably what they don't realize is that premiums don't have to be expensive. Some of them are actually very affordable and they can be paid quarterly or even monthly. Whereas if you compare it to not having insurance and having all of a sudden to pay a huge amount because you got hospitalized or because the breadwinner passed away, that's a huge financial loss. And if you don't have insurance, that's what you'll be confronted with. And so if you compare which is more expensive, a small premium or the amount you'll have to pay without any savings, then clearly the cost becomes justified, very much justified.
Makes sense. Good perspective. And the last, no hurry?
No hurry, especially for the young people or those who are single.
First jobs,
they say, I don't need insurance, nobody's depending on me, or I'm still young, I'm very healthy, nothing's going to happen to me. Well, for those who are single and they think, well, I have no dependents, eventually some of them will get married, and it's always cheaper to buy when you're young. So maybe you don't need it now, but the need might come later on. Number two, for those who think they're healthy, they're in their 30s, they're athletic, they say, oh, nothing's going to happen to me because I'm healthy.
I feel invincible.
You feel invincible. But there are people we've heard of, right, in their 30s and 40s at the prime of their life, and some accidents happen or they get sick. So for as long as we don't know what the future holds, and no one can claim that they know what the future holds, then always the need for insurance is very much relevant. So
very preventive, especially. I mean, that's kind of the perspective. No?
Right.
You don't want to have to think about it when
the time is already there.
Right. Okay. So let's talk about the different types of insurance.
Okay. Right now there are more than one type of insurance. There are probably about 4 general types of insurance. One of them is a term insurance. This is the cheapest form of insurance because it just protects you for a specific period of time. So if something happens to you during that period of time, then you get paid the benefit, or your dependents will get paid the benefit. If nothing does, by the time the term expires, then that's it. It's much like a car insurance. Protects you for a term, very cheap. It doesn't have any cash values.
It's a just in case, no?
It's a just in case you don't get anything back. The other type of insurance, whole life, we call it, protects you for life. So it's not just for a fixed period of time, protects you for life. And it does earn cash value. So what does that mean? You don't have to die to get anything,
to get any return,
yes, because it accumulates cash values that you can withdraw from if an emergency arises. You can even accumulate the cash values so that if you reach a certain age, you no longer need the insurance. You can cash it in for an amount that you can use for retirement, for travel.
Right.
So it's like a double, it's like a savings and an insurance at the same time.
And then the premiums are paid all throughout the
There are also variations. You can pay it for life. You can choose to pay it for a limited time. There are companies that offer 10 years to pay, 5 years to pay, and these days even one single pay, and you're covered for life.
Okay, that's whole.
That's whole life.
Excellent.
The other type is an endowment. This is like a cross between a whole life and a term, because an endowment product has a fixed term, but it earns cash values.
I see.
So unlike the term insurance, which is purely
it's
protection,
done when the term is over.
Yes, this one has cash value. So at the end of the term of an endowment, let's say 20 years, you're covered for 20 years. At the end of the 20th year, you get something back.
Right.
So again, you can use that money for whatever purpose you may want to use it for.
Is that almost like the pre-need?
A little bit, yes,
Similar.
because it helps you fund for things like education,
for a
retirement.
set period, you're guaranteed,
yes,
no? Okay.
Right.
Excellent.
And
then
the last one is the VUL, we call it, or the Variable Universal Life. It comes with an investment component. So it's both an insurance that protects you and your loved ones if something were to happen to you. At the same time, you get to invest part of it in a fund of your choice.
I see.
And there are stocks, there are bonds. And this particular type of insurance has the potential to earn sometimes even more than what your money would earn in banks and in other investment
Which is always good, of course.
Of course, yeah. So you beat inflation at the same time. And
you're protected back.
Yes, and the earning power is much greater.
Right. The premiums for the VUL, how do they last for the length of? Is
it's
it the same
also flexible.
Okay.
There are VUL products that are one-time pay.
Right.
There are VUL products that are 5 years to pay, 10 years to pay, or whole life.
And I did not ask that earlier, but for endowment, it's the same also.
There are
Premium
different
are various
terms, different terms,
ways of
different
paying
paying periods
premium.
as well.
Okay, excellent. So, given those 4 types, which would you recommend for different types of personalities or life stages? Yeah.
Yeah, I think a lot of factors have to be considered. It's always best, really, I just want to advise people also to seek advice from trained financial planners or financial advisors, because the type of insurance that would suit a person will depend on their circumstances, a lot of factors, their stage in life, their needs, and also their budget. So, but just to give you maybe like a kind of general say, like term, if your need is short, like for example, you borrowed money from a bank, there's a fixed term to that, right? Like maybe 5 years to pay. It might be good to get a term insurance, because then for the time that you're paying the loan, you're covered, so that if something were to happen to you, the bank won't have to run to run for money from your family.
Yes.
You'll have that insurance to take care of your loan, and it's fixed. You know, exactly.
There are a number of loans that actually have that built in.
Some banks actually require it even.
Yeah.
And then whole life is also a bit affordable, because as I've mentioned, you can actually choose the pay for life option.
Your options for payment.
And if you have young children, maybe age 0, where you foresee you'll be needing insurance for the next 20 years until they're well on their own, then you probably need a longer term insurance, in which case a whole life would make sense. Plus it earns cash value, so you have that.
Startup families, parang, hey, for my kids, okay, makes sense.
The VUL is for someone whose appetite for growing their money is there. You know, they're not quite satisfied with the modest returns you get from guaranteed investment products, because variable universal life tend to grow more because they're invested in different investment instruments. So for those who have a little bit or a little more appetite for risk, wanting also higher returns, may also invest in a variable universal.
Right. So
it really depends.
So it will also be the person who might be thinking of financial instruments to invest in, but they're saying, hey, this has a tuck-in.
Correct.
This might be an option as well.
Yes, at the same time, they still need protection because they have children, they have people depending on them, but yet they want to grow their money at the same time. It's like a 2-in-1 product.
Yeah. Okay, those are the ones I was interested in actually when I was looking. Let's talk about miscellaneous questions. Like people will say, hey, you know what, isn't the insurance of my company good enough? What are your thoughts?
Well, in some cases they might be, although one downside to just relying on the insurance provided by your company is that if you leave, that normally terminates with your employment. So if you have people or children or other people depending on you, depending on your income, it would be good to have your own insurance so that even if you were to resign from that company, your insurance is still there. Because if you don't have any other insurance aside from that, once you resign or if you're let go by that company, then you lose your insurance cover.
Okay. What about questions that people have, such as, you know, let's say even for the term, if I don't get the benefit for the period and I paid, what happens? I mean, is that a waste? I mean, I'm sure that's a common question that you encounter.
Well, yes, some think of it that way, that if I don't get sick or if I don't die,
sayang,
I just wasted my money. But really not, because if you really think about it, since you really never know what will happen, during that time that you were covered, you have that peace of mind. You have that peace of mind knowing that if anything should have happened to you, your family would have been taken care of. So it's really for protection.
It's really to help protect, you're saying. So let's go to the Philippine scenario and look at it a little bit more in detail. Which one would you say of the four types generally people are opting for or should look into, or is it really case to case?
Traditionally, it would be the whole life.
Whole life.
But lately, in the past, because I guess that was the one that was most common before. The VUL wasn't available yet before. The term, as you said, there aren't any cash values to it, so people see more value in whole life where you get something. If you cash it in, you get something, you can borrow money from it. It's more flexible. The variable universal life in the last maybe 4 or even more last years has really grown in popularity just because of the investment component. The potential to grow is higher there.
So if we were to summarize like the action step for Filipinos, the 98%, what would it take for them? I mean, after hearing all this,
well, hopefully this show will help. We're hoping, that this show will help open their minds that really there's a need. I mean, for as long as you have people in your lives whom you love, whom you take care of, there will always be a need for insurance. And that it doesn't have to be expensive. And it's a very responsible move to have one because it really makes sure that the people around you will continue to live the same quality of life you are providing them now. So.
I like that, the quality of life especially. You know, we'll have more questions for you from our viewers next. But right now we have to take a short break. Stay with us on The Money. We'll be right back. Welcome back to On the Money. Time now for a regular Salve Says segment with Salve Duplito.
There's a hot debate that has been going on for decades about the benefits of buying term insurance versus whole life insurance. What's all the commotion about, you ask?
Let me run you through the jargon. Term insurance is pure protection. You pay an amount, company makes sure that in the event of your death, the people you leave behind don't starve. But it's like auto insurance. You forget to pay, you're not covered. You renew every year. Whole life insurance covers you until you get old and gray, with some cash benefit thrown into the picture.
Don't get confused by all the complicated numbers. The only thing that you need to remember is that whole life insurance is a lot more expensive than term insurance when you're young.
So what does Salve Says recommend?
This is a well-kept secret by industry insiders. Term insurance is not sold to you because agents get very little commission from them.
But for young parents who have critical need for high coverage but a very little budget, they are the only option. Let me tell you, a 38-year-old will have to pay $240,000 per year for a $5 million whole life policy. For the same coverage, a term insurance will cost only 25,000 pesos, give or take a few thousand. So let me repeat that. When you're a young parent and a lot of other important budget items are fighting for your attention, do not make the mistake of buying whole life policies. But do get the 10-year or 20-year term policies where you lock in your annual premiums. Here's where I disagree with financial gurus Susie Orman, Dave Ramsey, and others. There will come a time when the premiums from term insurance become much more expensive than whole life. So before that happens, graduate to a basic whole life policy. This way, you get the best of both worlds.
Insurance was never meant to be an investment. I agree with what they say. Buy term and invest the difference. But make sure you invest, not spend the difference.
Still with us is Mylene Lopa, Chief Marketing Officer at Sun Life Financial Philippines, who will now answer some of the questions you sent to us via email, Twitter, and Facebook. Mel, what questions do you have for Mylene today?
Hi, Edric. I've got a few questions for you today, Mylene. Sure. And the first one comes from Claire. She asks, I'm single and have no dependents, no family members who need help. How important is it for me to have life insurance?
Okay, I have two answers for her.
Okay.
One is she may be single now, but if she does have plans of getting married and having children in the future, it's always wise to buy insurance when you're younger.
Okay.
Because it's cheaper. So that insurance will still come in handy in the future if she ever were to have a family or children.
But what if she doesn't?
If she doesn't, that's my second answer.
Okay.
The second answer is if she's single and she never has children or a family of her own, then insurance actually serves other needs like retirement funding or because as I've discussed earlier in the show, some insurance products come with cash values that you can actually use for other purposes, like a travel you'd like to take in the future,
right? Or
during your retirement years. For example, you're already out of a job and your insurance is still in force, then you cash it in and you can use the proceeds of that for your retirement.
Okay. So, but is it a good idea to have an insurance policy for those things? What if you had a different type of investment for those things, for your travel or for your retirement?
Yes, there are also other investment options available for funding those needs, like mutual funds or other investment options. Yes.
Okay, great. So if she plans on having a family, maybe she should wait until she actually has that family to get her life insurance?
I'll just share a story with you. You know, when I first got my insurance policy, I was single. I didn't have a boyfriend at the time, so I wasn't thinking about having a family. But I did get an insurance policy because my thinking then was, if something were to happen to me, I did not want to burden my parents.
Right.
About having to, you know, they raised me, they sent me to school, and even at my final moments, they'd still have to worry about, you know, how to take care of my final expenses. So I bought that insurance precisely to spare my parents from the financial trouble of having to take care of all those. So that's another reason why someone should get an insurance.
Okay. Okay, great. So if you have parents who are dependent on you, even if you're single, it's a good idea to get it.
Yes.
Okay. Okay. Well, we have another question, and this was sent in by Steve. He asks, do I still need life insurance when I'm already invested in mutual funds and stocks? If I die, my family will be able to cash in or continue to benefit from my investments. So what is the benefit of insurance for them?
Okay. Well, if he already has investments in mutual funds and stocks, and it's already sufficient to ensure that even if you were to go, the family can still, maintain their standard of living, then that will be fine. That will take care of that. But one thing about stocks and mutual funds is it's not guaranteed. You never know when the time comes that you have to go, whether at that moment the stocks are performing well. So that might be a time when the market is down and actually your investment has lost its value. Okay. Insurance, on the other hand, is guaranteed. The death benefit is guaranteed. Regardless of market condition, whether stocks are up or down, the amount of death benefit is guaranteed. So that's the difference. That's the advantage of having an insurance still.
Okay.
Because you're sure of the amount that your family will get.
Okay. Okay. Yeah, that is a good reason. So I suppose if he's worried it might drop, then
yes,
that's their guarantee.
Yes, because you never know when these things will happen. You can't say that, when I go, I'm sure the market will be up and my
I'll
stocks
be about
will be
this
enough.
age. And right.
Yeah.
Okay. Okay. So Steve, yeah, you better maybe get one life insurance policy for yourself. We have another question from Jen, and she says, my parents are getting older and my father is already retired. Is it still possible for me to get a life insurance policy for them in case one or the other goes? I am willing to pay for it, but it would not be a policy for me.
Yes, it's possible. Actually, some companies insure people well above their retirement years.
Oh,
Like
wow.
some companies insure people until they're age 70. I believe some even older. So it's still
Okay.
possible for her to get insurance for her parents, where she's the payer and the parents are the insured.
Okay. Now, insurance is also not just for dying young or unexpectedly, but
Yes.
it's also for when you live too long.
That's true.
Talk about that. Living too long.
Yeah, when
Yes.
you,
Good
when
problems.
when you burden people by living too long,
Exactly.
what happens then with your insurance?
Exactly. You're right. Insurance is not just for dying too soon. It's really for living too long too. Because I'll just share some statistics.
Yes.
In the Philippines, when a survey was done of people aged 60,
Yeah.
over 40% were dependent on their relatives.
Almost
And
half.
only
Wow.
2%
I believe that.
were financially independent,
Wow.
like
Yes.
really self-sufficient. So, and that is what we mean by the danger of living too long.
Mm.
When you retire, let's say at age 60, and you live, let's say, up to 80 or 90, that means you have 30 more years to fend for yourself without the
Right,
income
right,
that you earn from your job.
exactly.
And that's what you have to prepare for. An insurance policy can also address that because of the investment component of a
Right.
VUL or the cash values of whole life.
Right.
The money can accumulate so much so that by the time you reach 60 and have to retire, you can cash it in and it can cover for your remaining years so that you don't have to depend on your relatives or,
Right.
you know,
So it can cover you for another 30 years?
the fund that it has accumulated, if it has accumulated enough, can actually, you can actually spend that for your retirement expenses.
Okay. And would you take this out on a monthly basis? Could you cash in the whole thing? How would you normally do it, and how would you recommend somebody
I
do
believe
this?
there are variations. You can take the lump sum amount right away, or there may be some facilities with other financial institutions where you can leave it and withdraw periodically.
We have another question, this time from Jason. What is term life insurance and why would I need this? I have just taken out a loan for a new business. I think you discussed this earlier.
Yes, I
Yeah.
did. And so if he has a loan, and I presume that loan would be payable over a fixed period of time, a term life would be good for him, especially if he has dependents. That way, just in case something happens to him and he's unable to pay off the loan, his creditor would not have to run after his family for the payment. The
Right.
insurance, the term insurance, can settle the loan he would, if ever, leave behind.
Okay. Oh, that's good. But I guess he should maybe also get some kind of other insurance.
Yes.
So
for,
if he
for
had
another purpose.
if he had life insurance, would he need to get this term insurance when he was getting this loan?
It would depend. If he has a life insurance, but the beneficiary that he assigned is someone else, like his children, then probably he would need to get another one where the beneficiary would be the creditor.
Oh,
So that you preserve the other one for the original intent.
exactly.
Otherwise, it might get diverted and your family might be left with nothing.
Okay, great. Thanks a lot. Okay, anyway, send us your money questions via email or through Facebook and Twitter, and we'll try to answer them in our upcoming episodes or on our next Q&A Friday.
Mylene, Mel, life is full of surprises, as you mentioned.
Yes.
Best to be prepared.
Exactly.
That's our show for today. I'm Edric Mendoza. Join us again tomorrow for more talk and tips so you're always right on the money.